This is Scott Bauer from Prosper Trading Academy and your SIBO Vol 411. What is a normal VIX or futures curve? Well, typically we see a positive or upward sloping futures curve in the VIX where prices in the future are higher than current or what's known as spot prices. This is known as Contango. Contango happens about 80% of the time, and under normal market conditions, it makes sense that prices of futures contracts increase the further out the maturity date is, since they include investment costs like carrying costs or, in the case of a commodity, possibly storage costs. Like I said, the VIX futures curve is in a state of Contango typically about 80% of the time. But what happens when that curve becomes inverted? That's called backwardation. And backwardation happens when current price is higher than prices out in the future. And that can signal some imminent fear in the market. Remember, this is really a measure of sentiment, and pricing is always based on supply and demand. So think about what happens to a stock just prior to a big announcement, like an earnings release. Think about that volatility. The implied volatility rises into that earnings announcement because the expectation is that there's going to be a higher than normal move due to the once a quarter or so announcement. So the demand for those shorter dated options increases. That increases volatility. This is the same concept where the VIX flips to a state of backwardation. But as just mentioned, backwardation only occurs about 20% of the time and will typically normalize towards a more normal curve fairly quickly. This is Scott Bauer from Prosper Trading Academy and your SIBO Vol 411.